Thank you, gentlemen. Axel, John, and Martin. It's a pleasure to see you all here today. Thank you for coming. Axel, I've spent the week with you. It's good to see you again. It's an interesting time for the G20. Lots of topics, some of which I noted here this morning, but many others will be markets discussion. And we've got a full range of topics we're going to cover here in our 55 minutes. And then I also have an iPad here, so if you have questions, we will take questions from the audience. Just send them to me and I will scroll through them after we get through a 20 or 25 minutes of discussion here amongst ourselves. And I do urge you to please table your questions. We want to hear from you as well. Axel, I'm going to start with you. You're a former central banker. You've been in around policy circles your entire life, as well as academics and banking. You've been to these G20 meetings. This is an important one, an important time, given trans-Pacific tensions, transatlantic tensions which seem to know no geography. How do you see the weekend unfolding? What worries you most, and are you optimistic that we can make some progress in some of these top issues?
So I guess there are two topics that are on everyone's mind. One is the continued escalation of tariff disputes between the United States and China. And largely in response to that, all of you, if you ask your economists in your organization who are putting together forecasts, they will tell you our forecasts are off the table if this continues to escalate. And we've already seen that in the fourth quarter. If you look at the pattern of fourth quarter, first quarter growth and what we've seen for the second quarter, this comes at a point in time where there was a fragile development in the two last quarters of last year with a very strong reduction in global growth in the fourth quarter, a rebound to some extent in the first quarter, some stabilization and improvement, and we're starting to see weakness again in the second quarter, and this could continue into the second half of this year. You can easily take, when you look at US growth, you can probably take 0.7 of growth in the last half of last year out because of tariff fears and impact, if you do the estimates, and a number that is between a quarter, maybe even up to 0.5% of growth in the second half of this year could come off if we continue to escalate tariffs. This would amount to basically around 100 billion impact on US growth and US GDP, plus similar size, largely larger for Japan. So the second question that is arising from that, if there are these escalations in trade, how will central banks respond? I think central banks have firmly taken the attitude, and you see that in recent statements by Jay Powell, that they're not going to penalize the economy for the effects of policies, even if they think that those policies are unwarranted. They're going to try and have an impact in mitigating the impact of those policies on the economy. And so the whole discussion about what the Fed will do going forward, I think the market has overpriced the amount of rate cuts that the Fed is likely to do. If you listen to some of the key decision makers like Charlie Evans, if you listen to Jay Powell, there is no imminent rate cut. There is a likelihood, if further weakness in the data evolve over the second half of the year, that they might consider corrective action, but it's more going to be seen as taking the top out of the recent tightening cycle rather than fundamentally reversing. There are some voices, you might have seen Larry Summers' piece in the FT, that call for precautionary rate cuts. I don't think the Fed is going to do that at this point. So there is a clear signal that they will respond to weakness, even if the weakness is policy-induced and might by some be seen as a policy mistake.
So is that a Powell put that you're talking about?
Sorry?
A Powell put?
No, I would say, the Fed increasingly is facing a lot of headwinds. And but when I look at what the Fed is doing, and I was recently, witnessing a panel among various central bankers, former central bankers, some are concerned about too much influence of markets over central bank policy. Others are concerned about political influence on central bank policy. And so the central banks are navigating a very difficult environment because we all know that what they do now in trying to mitigate the impact of policies on the economy, they can do for some time, but they cannot permanently isolate the economy from those impacts. So the fact that the US has some room to maneuver, I think it would be unwise to assume that they will not use that room to maneuver if the economy substantially weakens. However, I think the current pricing in markets is overdone, And should these tariffs not escalate, there is a lot of room for complete repricing in the markets and some upside related to that. Room to maneuver in Europe and in Japan is much lower. And therefore, the ability to shield the economy of a negative impact of an escalation of tariff is not as strong, because continuing what central banks have done so far will have much less of an impact than reversing policies, which the Fed is able to do. So I think we are in a difficult environment. And again, we're in a point where everyone focuses on central banks being sort of the savior, and central banks coming in to rescue markets or to rescue the impact of policies. And that is not a role that central banks can play forever. So I think some reshifting of the policy mix towards more fiscal policy action, you're seeing that discussed here in Japan, and less reliance on monetary policy to save the day is probably warranted at this part of the cycle.
John, welcome.
Thank you.
You're our newest board member. Thank you for coming and spending time with us. Obviously, you have a particular insight on how you see global economy. Your chief economist, Jan Hatzius, this week sounded a little pessimistic, not as pessimistic as some on Wall Street. How do you see the global economy, and what do you want to hear out of this weekend's meetings that maybe changes your perspective?
Well, I would certainly echo Axel's comments. It worries me how much influence the Fed has in market sentiment right now, and I think the market is very focused on the Fed's next move. And I wholeheartedly agree. I think the market is overpricing what the Fed's likely to do in the near term. And I think it'll be really interesting to see how the Fed weighs the sentiment versus data argument in its own thinking, and I don't have a prescribed view as to what they will or won't do. But the market is certainly pricing in more than 100 basis points of cuts now, in terms of looking at the options markets, what's really priced in. So what that belies the fact that the market's kind of assuming a fairly negative set of facts evolving over the next handful of weeks and months. Maybe that'll pan out that way, and maybe the Fed will move that way, but I think it's not a foregone conclusion. And I would tend to think that they'll be more reliant on the data than they will on the short-term sentiment, but we'll see. In terms of our client flows, the last 30 days has been meaningfully more sluggish. There's no question that clients are on the sidelines. It's pretty hard to be aggressive right now in terms of moving your portfolios around if you're running a big institutional book. If you're a CEO, it's pretty hard to be particularly aggressive or ambitious in making M&A strategic decisions or capital decisions. So I sense a very dramatic shift in sentiment in the last 30 days or so, really since the President Trump's tweet, in early May. And so we're basically constructive on the global economy. Jan, who I spoke to again this morning, to kind of level set our own views, I think we both see it the same way. The economy is fundamentally strong around the world. There are pockets of weakness, the data in some of the European countries less so. Right. But broadly speaking, we're pretty fundamentally constructive on the economy. But this sentiment shift is real, and if it persists for weeks and months, and the escalation continues, and we see in particular U.S.-China, kind of Cold War behavior in an economic context, that will weigh on the real economy and on markets, and depending on how the Fed, and the other central banks behave, we'll see how it plays out. But you have to be much more cautious and a little bit more worried right now. So
if there is an agreement at the heads of state meeting at the end of the month in Osaka, then could you see sentiment shift quickly? Would you expect it to shift, or do you think there's more
again, I think the market may be too optimistic about what's achievable, in this G20 summit. I mean, I think the best you could hope for is that they agree to put negotiations back on the table. Right. I don't really see how they walk out of there with a deal, at least based on my own interactions with policymakers in Washington and policymakers in China, and I've been in both in the last 3 weeks. I don't see a scenario where there's a deal that emerges. Even with all Trump's unpredictability, I still think it's more likely the best case is that they agree to put negotiations back on the table and they start from there.
Martin, you've just come. I assume were you at home in London before you came here?
Yep.
Were you at the state dinner?
No, sadly not.
And how was the president received in London? And given the prism of the spending 48 hours with the president in your country, how do you see this weekend's meetings?
They did a pretty good job, I think, of keeping a lot of the rioting away from him. But I saw the cavalcade, or his motor cavalcade. It must have been about 25 vehicles. I mean, it is an incredible show when he comes into town. I mean, it really was. I think he got on I think it went okay as far as the state meetings, etc., and he was shown the right respect that the President of the United States deserves to be shown. I do think we're a bit short-sighted in the UK of sort of whatever view you might have of him of criticizing the president of one of our largest trading partners. So I'm glad it went as well as it did, actually.
And do you agree with John and Axel with respect to how they see flows and sentiment from their clients?
Yeah, I mean, definitely. I mean, there's been a big shift. Actually, I think it started more towards the last quarter of last year. We saw the shift really from growth stocks to value stocks. Then we had a bit of a rebound in the first quarter, which I must admit I didn't think was justified. And we're seeing back to what I think the sentiment is. There's definitely, I think this the trade dispute with China is going to last longer than the market is pricing in. And I find it fascinating that 3 or 4 months ago we were talking about how many rate rises the Fed would have this year, and now we're talking about the complete shift to the opposite extreme. So it's fascinating how quickly it's changed, and I think it's just beginning to dawn on a lot of our clients that times are going to be really tough. So we are seeing a big trend now as from public markets to private markets to try and dampen volatility in portfolios. So, you know, the big asset owners who have about 15% in private markets at the moment are talking about 20, going to 20%. But when I was in Canada last week, some of the big asset owners already have 50% of their portfolio in non-public markets. So they're giving up a bit of liquidity for better returns and dampen volatility.
I want to come back to the public market versus the private market in a moment. Axel, let me turn to you again as a former policymaker of the G20 this weekend. The G20 played an important role in the midst of the crisis. We had the Pittsburgh Summit, London Summit. They were seminal events in bringing confidence back to the markets. Does the G20 matter anymore? And what can they possibly achieve this weekend, other than some of the things that we'd like to work with them on, that might restore confidence in the markets?
So, you know, you said one area where we want to work with them is on this debt transparency issue. Again, there's we're making progress, we're not quite there. In general, I remember many of the G20 agendas are very long-term agendas. When we had the presidency in Germany of the G20, 2004, the main topic, and we did that with Mexico, was developing local currency bond markets. Fast forward 15 years, it is again the topic we talk about, and if anything, we're probably not as far into it as we were 15 years ago. There's much more dollar dominance again in international market than we saw at the start of the century. And so we're still in a world where basically the US is the most important economy. Yes, there is some rivalry increasingly coming from China, which is emerging, has emerged, and is becoming a very strong economy that will catch up with the US. I think that part is not stoppable, but it may be delayed. And that's where I think some of the trade disputes come in. In general, I think the G20 is a forum that many talk about the end of multilateralism. I don't think that that is the case. I think it's very important that we continue to work together. Yes, there has been an unorthodox shift in US foreign policy and US trade policy, but markets tend to generalize. Markets tend to take this shift in the US as a general shift across the world, and that's not the case. If you look at European markets, there is increasingly a discussion about how Europe can grow further together. Yes, UK is a special issue here, but don't let Brexit and the debate around Brexit mislead you that the rest of Europe is actually talking a lot about, we were in Paris just a week ago, a lot about further impetus. How can we grow the European project? In particular, now there are headwinds coming by some not identifying with the ultimate objective. So I don't think multilateralism is off the table, and we will probably see that coordination as we might face some headwinds will be very, very important. Because we're in a dollar-dominated world, any reaction to a double dip in the economy, which is what the market is starting to price, will require not just a reaction by the Federal Reserve, but more concerted action by the Federal Reserve and other central banks. And for example, dollar swap lines and the ability to channel dollar funding into economies where it's needed will be very, very essential. So I think beyond the trade discussion, there will continue to be collaboration between financial institutions, central banks, and that will be part of the remit of how we can mitigate some of the impact were we to see a double dip. You know, and in general, what is also very clear, as I said it before, the only country that can directly shield its own economy against a double dip scenario is the United States. There's much less ability to do that in Japan, there's much less ability to do that in Europe, and even China, who have very strong domestic policy tools and can use them, find it very hard to get traction with these policy tools, even they're becoming more expansionary. So I think collaboration will be a key element, and that's why the G20 discussions are important. And we might not achieve as much progress as we hope. I fully agree with you that getting negotiations back on track is going to be useful. But then let me make one last caveat. The tariff discussion in Mexico has really been quite damaging in terms of how much certainty you can achieve, even if you sign the trade agreement. Right. Because that, at this point in time, will be a big disincentive for China to put a lot of focus on getting a trade agreement, because the question will be, what is it worth if there are other areas and technology and other conflicts are going to continue to linger? How much traction can you get with a trade agreement that doesn't help resolve or doesn't even address some of the bigger concerns around technology and about geopolitical and geostratospheric discussion? How can we get traction with trade alone? And so it's going to be a much longer debate outside trade. And I think the market is too focused on the trade impact at this shorter point. The bigger issues will continue to be on the table and have to be discussed. A standoff in these areas will not be useful.
John, we're in the third largest economy in the world, next door to the second largest economy in the world, China. Goldman Sachs has had a huge presence in both countries, certainly in China. I used to work for Hank Paulson, who used to regale me with stories about Goldman's role in China. Tell me a little about your business. How do you see the Chinese economy, the Japanese economy, and regionally? What are you doing here? What are you seeing?
Sure. Well, we've had a long presence in Japan, to start in Japan. And I've been here for the last couple of days meeting with our team and going through our operations. And not to give a Goldman Sachs commercial, that's not the point, but we've never felt better about our business in Japan, nor have we ever felt better about the opportunity in Japan, which is less about runaway growth, in the kind of China context, and more about the opportunity for corporations in Japan to be repositioned, either by outbound M&A or by having to deal with more governance in the shareholder structure, be it activism or otherwise, that we see coming increasingly into this marketplace. So we're very optimistic about the opportunity for firms like ours, UBS, Goldman Sachs, and others in Japan to do what we do for a living, which is to help companies, advise them in their activities over time, and risk intermediate. We built quite a sizable risk intermediation business in this marketplace, and as the cross-border flows continue to be robust between the Japanese economy and the rest of the world, we're very active in those flows, and that hasn't fundamentally changed. When you shift to China, it's been much more about capital raising for growth, which really takes the form of equity capital raising most prominently. So our business in China, which is a joint venture, we obviously don't control our business completely as per the Chinese regulation, is really about financing. Historically, when Hank was running it, was more about financing SOEs as they were coming to the public market and reforming the SOE sector. It's really pivoted much more now towards private enterprise. And you think about some of the larger, whether it's Alibaba or Tencent or even ByteDance or some of the other companies that have come public more recently, both in the Hong Kong market and increasingly in the United States, we're basically facilitating growth capital for the emergence of largely technology, but also healthcare, biopharma, and other emerging companies in China, which, given China's size and scale, when they emerge in size. When you look at the combination of Tencent and Alibaba, that's $1 trillion in market cap, those two companies alone, just based on the size of their domestic opportunity. And so these companies have enormous market opportunity in front of them, and we're there to facilitate that transition. Over time, I'm optimistic that the market will open. I do believe the Chinese want to open their markets, their financial markets and their broader markets. I think it will take time. It will go slower than those of us in the West would like it to go. But at least in my conversations, I sense a distinct shift and even potentially an acceleration trade deal, obviously an important component of that, but putting that on the side, I think the direction of travel is clear. And as we have more ability to control our business there, and as others do as well in our industry, we can facilitate more domestic financing capability onshore and also have more cross-border bilateral investment as a conduit to the rest of the world, which I think is important to them strategically. So we're quite optimistic about it, but you have to have a long-term view.
I like what you said. I was just in Beijing a few weeks ago for the Belt Road Forum, met with senior Chinese officials who said, we are open for business for the financial service industry. You're picking up market share there. You're growing your market. You are as well. But there's a welcome mat for Western financial institutions. Martin, I'm sure you see the same. How do you see your business here in the region?
Oh, I mean, the region is growing so rapidly compared to the rest of the world. So obviously we've been located here in Asia since '92. So it's a great market to be in. It is still a market, though, dominated by the large asset owners rather than wholesale or retail. Japan is a very interesting market for asset managers at the moment, just because of the need, because Japanese bonds are yielding what they are. There's a great opportunity for Japanese institutions to invest more overseas, and we're certainly seeing that trend, as John said, both in M&A and investing money overseas. European credit, these sort of asset classes are getting more popular here, just because of the need to have some sort of yield in your portfolios here.
You mentioned earlier about the rise of private markets rather than public markets. Jamie Dimon's been talking for years now about the size of the public market in the U.S. is half what it was 15 years ago. There seemed to be a disincentive to go public. More companies, certainly the tech sector, staying private longer. How do you see that shaking out? How does that affect your flows?
Yeah, I mean, there are a lot of two or three big trends affecting the asset management industry. One is, as we've said, public to private, also active to passive, and then really severe pricing pressure as well. Although in passive, the pricing pressure is very, very severe, even compared to active. So hence the reason the long-only asset managers are tending to have a very tough time, because the asset owners that we traditionally manage money for have been selling public market equities and buying infrastructure, private debt, private equity, whatever it is. So it's having a big effect on the traditional long-only asset managers, and fees in those areas tend to be higher than the fees even in active equities.
Axel, I'm going to come back to you on market fragmentation. I mentioned this morning, it was an FSB IOSCO report, came out overnight. FSB's made this an important initiative. We've talked about market fragmentation. We've talked about it at our board meetings, within jurisdictions, across jurisdictions. It's not just the end of globalization in terms of trade and more regionalization. We see it in terms of capital flows. How do you see, and what worries you about market fragmentation? Do you see it? Is it something that's visible? And how does it affect your business at UBS?
So just to add 2 points on the China question before I answer that. We are exactly, as our friends at Goldman, positioned in these markets here more on the wholesale side, because we're not a retail bank outside Switzerland. So it is largely collaborating with financial institution and the institutional business that we've done, whether it's IPO markets in China, whether it is opening of Chinese equity markets or bond markets to the rest of the world. Our presence onshore basically is a mirror image of our international presence. So we bring global assets to the Chinese economy, and we try and bring Chinese assets to our global investors. And, firms like ours have a very strong, we're the go-to companies for the northbound traffic on the A-shares market and on the Hong Kong-Shanghai Bond Connect. Those connects are increasing. Zurich, London, everyone is negotiating connection to the Chinese markets, and that will allow us to run some business like custody in Zurich or in our home markets and open up for a Chinese investment universe. And that makes it absolutely essential to develop assets onshore that have stable features, because we've seen boom and bust cycles in China so far, and that has spooked international investors. So it needs to be the quality private assets we develop in China to bring to international investors that will determine how that will happen. And I fully agree with what was said. They will not open as fast as we hope, but they are on a steady path and will open up at their same speed, internationalize the renminbi, and internationalize their market, which has one big implication that investors, I think, haven't fully grasped. They're now included in the MSCI, the Bloomberg Bond Index. But if you look at the emerging market index, with current dynamics, China is going to be close to 60% of any emerging market index, whether it's bonds, equity, or whatever.
Right.
So that warrants a full China standalone allocation, because otherwise it will crowd out your entire emerging market portfolio. And investors haven't adjusted to that yet. So I see a major shift in that, because you're going to have then the question of how do I right-size the China exposure relative to my emerging market or US or global market. On fragmentation, I come from Europe, so anybody will answer the question, do you see market fragmentation? Yes, we're seeing huge market fragmentation.
It's a way of life in Europe.
It's, if you look at the US market has size. If you look at China, China has size. Europe is a couple of dozen of fragmented markets with national champions. They're overbanked. And one reason why European banks have not gained dynamics is market fragmentation. Now, the downside I see is Europe is working at that. Alberto Giovannini had almost 20 years ago identified the so-called Giovannini barriers, which are domestic barriers to flows of capital and cross-border banking in the European Union. They're still with us. Now, the problem is, as Europe is undoing these, as we're moving to a single supervisor, as we're moving to a banking union, or potentially a capital market union, the problem is, with Brexit, Europe has embarked on what I think is a very wrong agenda, namely trying to eliminate internal barriers to capital and banking, but at the same time raising external barriers. We're seeing that from Switzerland. We will soon be joined by the UK in our non-EU membership, and we're starting to see it being more and more difficult to do cross-border business into the European Union, because there is, equivalence procedures are used to basically define lockout criteria rather than to open market. I found it very good that, for example, the US is reaching out and is granting equivalence to a number of countries. So at least on the international business, financial centers like Zurich can team up with London, New York, Singapore, Hong Kong, and Tokyo to form an international capital market world. But the European Union is at risk of locking itself out of that. And I think in particular, since the largest capital market, which is London, in the European Union, is about to exit. And so I think over the short term, fragmentation of markets will increase as a result of Brexit, in particular in Europe. And that's not boding well for European banks. European banks have not had a contribution to growth over the last 10 years. And as a result, the share of financial services in GDP has fallen. Unlike in the US, where the growth of financial services has been in line with GDP, and where the share of financial services in GDP has actually slightly increased. So we find it more and more difficult outside the US to compete with banks in a less and less level playing field environment. And whether it's regulation, which is fragmented in Europe, whether it's other areas like markets being fragmented, fragmentation is negative for global banks. It is kind of a protective shield for local banks. And I think that will continue to be the dominant topic in Europe. We need less fragmentation, not more. But unfortunately, what I'm seeing as a result of Brexit and the reaction of the Union to it, we're seeing more fragmentation to come, and that's clearly a gross negative for Europe as a whole.
One of the risks to me for Europe, I couldn't agree more. I think that if you think about what Axel said about the amount of capital that will ultimately flow to China as MSCI inclusion increases and as the markets do open up, and this may take time, so it's not happening next week or next month, but given the amount of flows that will head that direction invariably, given the amount of innovation that's happening in the United States and in China, we can debate how much innovation in China versus how much theft of other stuff. But nonetheless, there's an enormous amount of technology investment being made in China in AI, in the cloud, in machine learning, and so forth. That Europe risks being fragmented and small and non-innovative in the context of what's going on in these global markets, and the dollars or the euros or whatever the currency of choice will follow in that direction. I think this fragmentation point is a big strategic risk for Europe in particular. It's not just a European issue, but it's probably most profound there. And that to me, as I think about our business over time and how we allocate our resources over time, makes me a little bit more concerned about the European story vis-a-vis what I see, particularly in this region and in the United States.
We're already seeing the flows into China, big flows going into China, Asia. I mean, it's by far and away our biggest selling fund globally. I mean, we're getting flows from Chile all over the world into China, Asia. So it is already happening, and there's some really good quality companies in the A-share market compared to, say, the skepticism there's been in amongst the bigger stocks. So it's already happening.
But actually, you mentioned Alibaba, Ant Financial, WeBank, huge players. Ant Financial has a money market fund larger than JP Morgan, unfortunately market cap larger than Goldman Sachs. They have 600 million customers. Is that part of the fragmentation story in Asia, that you're competing with entities that are regulated different than you are? John, or anyone?
Well, there's so much about China that's different. It's hard. Look, Ant Financial is a unique story. I mean, I think to me, what's interesting in China is how they've moved. They never went to the legacy structure of payments that we have in the rest of the world. They just went right to mobile and data and simplicity and transparency. And now everybody's basically you can barely transact with cash in China. I mean, you have to use the QR code to transact. So they just went right into the modern age, whereas the United States is still trying to transition from quite a legacy infrastructure with rails that have been in place a long time into something that's more contemporary. And I think that's the case in a lot of elements in China. You look at what Alibaba's doing in cloud. I was at Alibaba a couple weeks ago and just listening to their cloud story. It's Amazon all over again with a market of 5x the size. So I just think the scale opportunity for these companies, to Martin's point, these are good companies, and they have an enormous domestic opportunity. They don't have to compete with international firms in international markets to build quite a sizable business and market cap for themselves. So I'm pretty bullish on the domestic opportunity in China. And the question is how we all get to access it over what time frame.
Martin, I'm going to come to you. I'm going to start turning to the audience for questions. Please send them in via the app. The B word, obviously, Brexit. The Prime Minister May is stepping down. We will have elections for a new leader of the Conservatives sometime over the next few months. We'll know by the end of July. Boris Johnson, who knows? Maybe you have insights. What does that mean for the current discussion on Brexit, and what's your current prognosis?
I think it's quite likely to be a Brexiteer that wins. I think there's a good chance it is Boris Johnson because he is perceived as being able to win an election. So MPs will presumably vote for someone they think can win the next general election. I think it increases the chances markedly of a hard Brexit, though, because the results in the European elections showed the Conservatives they've got to deliver Brexit, or else they could really suffer disastrous consequences in the next general election.
So you think a hard Brexit has a higher probability?
I think it's a higher probability than it was in the past, because of the results that the Conservatives had in the European elections, and obviously Labour are a divided party as well. The perception that Labour are a Remain party is very misguided. They're as equally divided, or probably almost 50-50 between their MP constituencies that voted Brexit and those that voted Remain. The problem we've got is 2/3 of the constituencies voted out and 2/3 of the MPs are Remainers.
Right.
So there is a disconnect between what people voted for to a certain extent. So I think chances are higher.
John, you're prepared for a hard Brexit?
We're prepared for any scenario. Sadly, we've increased our preparation for hard Brexit in the last 6 months, but we're prepared for any scenario. And Our job is to serve our clients and manage our risk. And so if it's a hard Brexit, we'll be ready.
Financial institutions are fine. It's the supply chain that is
That's right.
that worries people.
So no second referendum and no general election.
I think it would be very hard to have a second referendum, and also there is no appetite for a general election amongst a lot of the MPs. No one's going to risk going to the country at the moment.
And I think you can see that, just if I may jump in here, you can see that because we just had an election around the European elections.
Right.
And so everyone is looking at that, and there's no upside for the established parties, be it in the UK, be it in France, be it in Germany, to go to a general election. In Germany, that's becoming an issue as well. If you were to have elections today, the current polling puts the Green Party ahead of the Conservatives. And so if you've not adjusted your portfolio for a German Green government, the recent data suggests that that is a not low probability. And that will completely change the entire European politics. It'll change investment horizons because they're going to green the political agenda. And so there is so many things in the making in Europe that I think the market is overly focused on Brexit. We adjusted our operation for Brexit on 31st of March, at the start of March. We didn't know it would come, but we basically have already rejigged our entire operation to when Brexit happened. And if it's a hard Brexit, it's going to be more negative than a softer one, but we're institutionally, of course, all prepared for it.
Let me follow up with you on that, Axel. With respect to the rise of the Greens across Europe, two things, and one is based on a question here, is the perception that the U.S. is deregulating while Europe is regulating more in terms of our industry, and two, how might the ascendancy of the Green Party accelerate that regulation in Europe and do so in a way with respect to greening the system, more greening factors, capital greening factors, browning factors. How do you see that?
So I think it's going to add another layer of regulation. That's what it will do. And whether it is stress testing for financial institutions on whether their portfolios are carbon bulletproofed. Of course, they will not, because they reflect past investment trends rather than future trends. So it will cause a major transformation also of investments, and in the investment universe, you will see sustainable investing, green investing increase. But as we also know, you can almost call everything green today. So you need to have the work done. You need to have very clear definitions. You need to have standards. You need to do the financial plumbing for these markets to grow. You need auditing. So there's going to be another layer of regulation and infrastructure providing and financial plumbing that needs to be done before we can reap the benefits of these investments. And so short term, it will mean some more regulation. And what I said before about fragmentation, we're moving from a destination that all the regulators subscribe to, which is single point of entry. That's where we all put our dials in our corporations. And what we're seeing is multiple point of entry emerging. And we've optimized our corporations for a structure of resolution that will not be the structure that will be operated, because there is a series of mistrusts and differential views. Everyone wants to have a better call over the domestic operation of any foreign banks, and this has been fragmenting the way global banks have been operating. So I see a lot of regulatory red tape, and of course it's very unsettling if the US is undoing some of the extreme consequences of regulation going forward, and Europe is still on a different trajectory. That will not increase the ability of European banks to compete with our US peers. I think in terms of products and in terms of how we run the banks, we could do that, but we face a different regulatory environment.
So let me turn to our US institution here. Is the Federal Reserve, are they giving you a regulatory break? Are you going to Washington?
I have to say, I listened to Axel's comments, which I again agree with, but I think that the deregulatory bent in the U.S. is more tone and narrative than it is reality. Mm-hmm. And I think it's going to be very interesting to see what the politics bring in the U.S. over the next 2 years vis-a-vis the election and then beyond, in terms of whether that turns into more actual deregulation. Because at this juncture, I would observe it hasn't really turned into actual deregulation. And I agree that if the U.S. gets more deregulatory in practice and Europe gets more fragmented and has another regulatory layer, be it on climate or otherwise, that will be obviously another detriment to the European story. But I wouldn't be willing to write the story in the U.S. as going clearly the way of deregulation. There's an enormously strong populist bent still, rearing its head strongly in the United States, and it's far from dead. And I think the deregulation story is still to be adjudicated.
And just bringing this back to the green financial instruments, obviously Mark Carney's been a leader on climate, and we have Mark this afternoon.
Yep.
He was really the leader for several years talking about the need to stress test balance sheets for climate exposure and stranded assets and such. And now we see with this Indice of the Greens a much broader appeal of a pro-environmental sentiment. How are you two managing your business in terms of products or your own balance sheet?
Well, it's changed fairly dramatically. Interestingly, the U.S. is lagging behind, actually. Normally, the U.S. is a leader in all things asset management, but in sustainability, they're definitely following. So the Nordics really took the lead, and the U.K. and then Canada, very big in sustainability. I mean, ESG is done. So if we take ESG, every fund manager in the world says they incorporate ESG in their investment process. Whether they do or not is a different matter. And then you've got to sort of move a step change to sustainability. We're definitely seeing a marked, our clients are telling us now more and more to interact with the companies we invest in rather than disinvest. So interact with them and talk about sustainability and how we get to a
As an owner investor, apply pressure.
Yeah, they're the owners, and of course we are interacting with the companies on climate, and then the next stage is obviously impact, and definitely the next generation after us are much more interested in impact investing, and that we actually invest for good, and that'll be a big trend going forward. So big changes in asset management.
And do you see a slippery slope beyond just environmental issues to include tobacco, military hardware? I mean, do you worry about where does this stop?
Yeah, I mean, I think that's where you've got to, as I say, have a dialogue with the companies, because we could have a company that we invest in where 95% of its business is good in sustainability terms, and 5% is not, and we would discuss with them, how do you disinvest from that part of the business, or have you a long-term plan for that? But it's not just as easy as going to a big oil company and saying, you've got to stop producing oil or whatever, because the other side of the equation, as we talk about in sustainability, is there are still huge numbers of coal-fired power stations being built in the world. So what we've got to do is try and persuade those to be ultra-low emission. It's a much more complicated argument than just saying don't produce coal.
Right, and get credit for if it's carbon capture technologies.
Yeah, carbon capture, all of these sort of things. But as I say, it's a very complicated, it's a much more complicated conversation you're having with companies now on sustainability. But it's good, and companies are very open to having these discussions.
We're similar. We're similar too. We're focused on the same issues, and we've raised ESG money and sustainable money in our asset manager, as I'm sure as Martin. I notice it in my shareholder base. My shareholder base is now asking me about our sustainability plans.
So this is not just a niche. This is
no, it's not a niche. It's
central to business.
I agree with Martin. I think the U.S. is behind.
Yeah.
We've made certain commitments. We've got a carbon neutral commitment inside of our company. We've invested or raised $80 billion in clean energy financing, or invested our own money into clean energy investments. We've got a target to get to $150 billion by 2025. We do a lot in impact investing. We've launched a $500 million investment fund focused with really our own money, effectively. We'll raise some outside money focused on female entrepreneurship and impact investing in that context. So we're doing the things that we think are right to move the ball down the field, but this is going to have to be a long game with a lot of purpose, I think.
If you had this bottle in a bank branch in the Nordics, people would close their accounts. It's that serious in the Nordics. I see you have got a green bit on your bottle here.
Of course, it's a green bottle. Axel, you've made sustainability a hallmark of UBS.
Well, look, we've been Dow Jones Sustainability Leader in banking for 4 years in a row. We've got a very clear mandate for our guys, keep us there, and do what is needed to develop the investment space on sustainable and green assets. And as I said, there's a lot of infrastructure plumbing you need to do. But let me make a different remark. Not just the corporates, it's becoming a general topic. If you look at the German election where the Greens are now the strongest party, and you look at every Friday, the school kids are out, not going to school, but protesting for the environment in the streets, not just of Zurich, but also most European cities. Those will be the voters of the future. And the established parties do have to cater for them and green their own agenda in order to attract these voters. And so it's not just a Green Party agenda that is successful. Because it's successful, it will be mainstreamed from parties that were solely focused on that to every party making that part of their political agenda. And so in Europe, I do see a big momentum, which is witnessed when we were in Paris, that in starting with Bruno Le Maire, the finance minister, but also President Macron, they were very clear. Because of the Paris Accord, they see that as their political preference to drive this further, and they're succeeding to win over most of the Europeans. And unfortunately, it is the fact that the US is lagging behind on that. But if you look at China, they've adopted that agenda as well, because every day, just having gone to China for more than 20 years, you saw how environmental issues became top of the agenda there. And they've changed the policy very strongly in that direction because there's a lot of mistakes they can avoid as they're industrializing their economy. So it will be a big issue, and it will be a big investment scheme. But again, it is still nascent. It is still a niche investment area that has to be mainstreamed. And there's a lot of work that needs to be done in terms of financial plumbing. And actually, it's not yet at the point in time where you will get excess returns if you invest in this area. This is still an area where you forego returns if you invest in green investments because they've not been mainstreamed. So there's a lot of work that needs to be done. And I think financial institutions are adapting to that environment. And we see it. We're a global wealth manager. When I have meetings 10 years ago, it used to be the patriarch of the family that decides about the investment strategy. Now you have the family there, you have the millennial children there, and they will ask, so what does UBS offer on green investments, on impact investing? So it becomes part of an investment conversation with the clients, and that's where it picks up momentum. There is a demand for it, so we have to basically increase supply of it. And that's sort of the way we look at it. It has moved, and we continue to sort of develop that.
In the closing few minutes, let me just turn to technology, and if we have any time left, we'll go back to some of the big global issues. Goldman Sachs considers itself a technology company. All my board members consider themselves CEOs of technology companies. JPM spending $12 billion, Bank of America $16 billion, Morgan Stanley $6 billion. You guys are spending a tremendous amount of money on technology for customer experience, for back office operations, greater efficiency. So how do you think about technology? Are you confident that what you're spending, you're getting a good return on it? And do you worry about cyber risk?
Quickly, it's the single biggest challenge I find in my job is how to apportion that spend, how to think about the return on that spend, and how to shift the spend from what we call run the bank to change the bank. So we actually disclosed, I think last week for the first time, that we spend about $4 billion a year. That on a percentage of revenue basis, that's pretty consistent with all the major banks in the world. But 55% of that would be run the bank. 45% of that would be invest in the bank for future growth and efficiency. And we'd like that 45% to be much higher. And we're trying to transition the 45 to 55 and the 55 to 45 and figure out what those returns are, which to my mind is about protecting that spend. One of the major things in any of these firms, I think, is you can easily pull back spend when you see weakness in markets as we do now and sentiment shift and you want to make quarterly earnings or annual earnings and you start to pare back. We've got to be very persistent in making sure we continue to make those investments in digitization, AI, machine learning, the cloud. We're launching a digital consumer platform. We've got a credit card partnership with Apple. So we're doing a lot of things in terms of new business builds. We're building a transaction banking platform. We have a lot of investment spending that we're undertaking to build businesses that are adjacent to our core strengths. And we have to keep on that journey. And yes, cyber is in the run the bank area. Cyber would be the fastest growing component. We term it as run the bank, not change the bank. It's kind of, you got to be protecting yourself while you're trying to grow. And that spend continues to grow at a faster rate than anything else we're doing.
Martin, how are you embracing technology? Do you feel comfortable that you're getting your money's worth out of what you're spending?
Yeah, I mean, I think like John was saying, hopefully the 45 reduces the run the bank to 45. So hopefully it allows you to reduce your operating costs. And because of the pricing pressure in asset management at the moment, it is absolutely essential that asset managers reduce the cost of running the business, especially from the moment a trade is put on the system to how it's settled.
I've got one last question for you, and then we're going to call it a day. This is specifically you, Martin. Climate scientists indicate that OECD countries need to eliminate their domestic coal power entirely by 2030. It'd be hard to do that in Germany. How do you see this timeline influencing your engagement with portfolio companies?
I think it's going to be difficult to achieve that. I think we've got to try and look at areas of persuading the coal-powered stations to be ultra-low emission, carbon capture, all of these things.
The transition.
Coal is still much cheaper, half the price, a third of the price of, say, LPG. So that is the big issue.
Gentlemen, I could spend the entire day up here with you. Thank you so much. Ladies and gentlemen, please give them a round of applause.
Thank you.